Good morning and welcome to the fourth of a KPMG Africa Conversation Series. I'm Alishia Seckam, and this morning we're broadcasting live from the KPMG headquarters in Johannesburg, South Africa. Now, over the next hour, we're going to be putting the spotlight on Africa's growing relationship with China. What are prospects looking like moving forward in terms of being able to leverage off the opportunities that this relationship brings with it, and at what cost? I mean, it certainly is a sensitive issue right now, following the South African government's failure to grant a visa to the Dalai Lama. Many asking whether the price we're paying for this relationship is actually worth it, and whether we're managing this relationship in the best way possible. In conversation with me this morning is Dr. Greg Mills. He's director at the Brenthurst Foundation. Gloria Sirobe is a CEO of WIP Capital, and then Glenn Ho is head of the local China practice in South Africa right here at KPMG. Joining our conversation from Kenya as well this morning is Katinji Kiragu. He's director at the African Development Professionals Group. We seem to be having some technical problems this morning, so he'll be joining our conversation as soon as we get the technical side of things up and running. But for now, let's start off right here in South Africa, Johannesburg. Glenn, and perhaps let's start off with you. To a large extent, Africa's growth momentum has been supported by increasing FDI from across the globe. Between 2000 and 2010, FDI's share of gross fixed capital formation in Africa came in at 20%. That's twice the global average. Let's take a look at the contribution China specifically is making to this kind of investment flow.
I think according to popular belief, a lot of it is still in terms of natural resources and minerals, but we're seeing more and more investment. And I think the biggest investment so far has been the ICBC investment in Standard Bank. But we're seeing more and more diversification, the type of investments. But we're also seeing a lot of small traders coming out, entrepreneurs coming to Africa, and also trying to ply their trade here in Africa.
Gloria, with that, are we seeing a change in perception that China extracts resources, reaps the benefits of it, without plowing back in terms of investment? Is there some acknowledgement of a relationship that's growing in a broader strategic commitment as well?
I think any investor who comes into any country is going to do the best for himself or herself. And it is going to take the investee countries to take the best out of that relationship. So the whole perception of China coming to take what it likes and leaving us and dumping us with it is really based on South Africans are not applying their minds to this. Or I wouldn't know what is happening in Africa, but in our case, in South Africa, as we polled, we are beneficiating the minerals. We are beneficiating the limestones with the support of the African business. There's everything decent about that relationship. So I think it is going to take what people do with that relationship than the Chinese coming to take what they like and not like. I don't agree with that perception.
That's certainly something that we'll be pursuing, actually managing this relationship as we progress through this conversation this morning. Greg, let's take a look at the way China makes investments for the most part, because it needs to be highlighted in that in most instances, certainly not in all, as Gloria has just highlighted, we see a value chain being driven, and it's primarily driven by government investment as opposed to private sector coming in. What's your sense of the investment model, of that trade strategy that we're looking at?
I'm not sure if there's an investment model one can speak of with regard to China and Africa. I think the picture is as differentiated with China and Africa as among African countries themselves. I mean, we have all sorts of different African countries among the 55 nations on the continent, some emerging from conflict, some big ones, small ones, commodity-rich ones, and so on. And I think China's strategy reflects in part that, but it also reflects the nature of business in China itself. There is the aspect which is government-directed, and as has been pointed out, there's also the aspect at the other end of the scale, which is very much the individual coming out to trade in African capitals. The person trading chickens in the Lusaka market is not the guy buying $9 billion stakes in the Congolese mineral market. And there's literally all stops in between. I don't think that there is a model for the simple reason, they may be at the top end, and I think that model has a lot to do with the Chinese, who have grown their economy on export-led growth at between 25–30% per annum for the last 2 decades, looking more at source to add value in terms of their export products in terms of their own beneficiation strategy. So at the top end, on the big mineral projects, there is a model. But at the bottom end, the small traders, and they're literally across the African continent in far-flung areas, rural as well as urban, in just about every different sector, I think they're very much self-starters. I think they're out there doing things for themselves. So to speak of a Chinese model towards Africa, I think is far-fetched.
Glenn, when it comes to that value add that China, brings, cynics would say that China, for one, would have to invest, let's say, in infrastructure, because that's the only way their extractive industries or investments are going to make sense for them, be viable, commercially. Just how much is being directed in towards infrastructure development on the continent? I
think a fair amount has been directed that way, but I think apart from being used for the extractive mineral sector, improving infrastructure for a particular area does actually improve the economic benefits and the economic strength of that particular area. So it does have those added benefits, and you'll have other industries growing around that as well. If you take the automotive industry, if you have, for example, a car plant, you've got all the allied industries that do set up around that area as well.
Can I jump in here?
Absolutely.
I mean, I think one of the things that China's been very good at in the mineral area is purchasing stakes and concessions for infrastructure. And essentially, it's been a bit of genius at this, a very bit of simple genius, which is we'll pay you an infrastructure which we'll spend on ourselves, although you will be the ultimate beneficiary of this, and we will get your concessions in return. And the Congolese example of the roughly $50–60 billion of copper and cobalt in the southern part of the Congo in exchange for under $10 billion of Chinese investment, much of which is infrastructure spent on itself, is a classic example of this. That's not to say that this shouldn't benefit Africans and benefit and lower our costs of doing business.
Exactly,
but we have to understand what the model is about.
Africa is being built up. In that context, though, the IMF has argued that we've got Chinese concessional loans like these raising the debt profile of African nations in a very big way. It's undermining programs to bring those kind of debt levels under control. What's your view on that?
Well, I mean, I think it has reduced debt levels, but of course it's also mortgaged Africa's future for a very long time to come by selling off large mineral concessions. So we've certainly, the debt debate in Africa is largely over. If we'd had this program 15 years ago, we'd probably spent a lot of time talking about debt and the role of aid in African development. And the one thing that China has done, it's dramatically changed that debate. The rise in commodity prices off the back of Chinese investment and, of course, Chinese demand has totally changed the nature of the development debate in Africa. It's made it much more African-centric, much more demand-driven in terms of external markets, and that's a very positive thing. Yeah. So some debt is not a bad thing, but, of course, exchanging commodities for infrastructure, of course, provides a different set of problems.
Well, we're going to try and bring Katenji into the conversation at this point. Katenji, thanks so much for joining us this morning. Looking at cooperation between Kenya and China, it's amongst the aims of Kenya's Vision 2030 specifically, and China's pushing for a greater role in the development of Kenya's infrastructure specifically. We've seen it via the rolling out of aid, soft loans. What progress exactly are we seeing in that regard? Unfortunately, we seem to be having...
Well, I don't think the development of Vision 2030 is really predicated exclusively on
Katenji, you can continue.
Investments from China. But I think what is clear is that in Vision 2030, Kenyans are very clear about what development they want to see and at what pace, and China is just one of the potential suppliers of investment and capacity and technology.
Just taking a look at that relationship, I mean, we've been talking about, the need for a change in perception in the kind of role that China is perhaps playing on the continent right now, where they are effective infrastructure suppliers on that side. You've been talking about Kenya managing that relationship better. There's sometimes been questions, though, around the kind of quality, that Chinese firms bring to the continent, then social standards by which they operate as well. Is that an issue being ironed out, or does it still present somewhat of a hurdle?
Well, I would suggest that maybe there's an exaggeration in that perspective for two reasons. One is, of course, Kenya, like the rest of the world, and a lot of developing world, is receiving a lot of, maybe poor quality consumer goods from China. I think it is a different ballgame when we talk about, for example, development of the infrastructure and so on. Obviously, China or farms don't come to Kenya not to make money, they come to make money. Therefore, there is a responsibility on the part of Kenyans to make sure that whatever they are doing for us is of quality, and more importantly, that it represents value for money. At the moment, I don't think we have had any development which involves a Chinese farm and which is of a major investment on which we have reason to doubt that we are receiving value for money. Unless maybe people can cite specific examples, which then of course can be addressed. Indeed, again, that is not would again not be unique even to China. It would be common in many other foreign investments where we don't get value for money. So I think this should not be specific to China. It would be a responsibility for Kenyans with regard to every other foreign investment and foreign farms involved in Kenya.
Gloria, that's certainly something that you touched on when we were chatting off air, talking about the fact that there's this extreme concentration on China and the way it makes investments, but it can certainly be attributed to other foreign players that enter the African playing field.
Yeah, FDI is FDI, and we're all crying for it. So at some stage, we should say it doesn't matter where it comes from. But the thing that I like with the China business is that, firstly, there was a China-Africa summit in 2006. That China-Africa summit was trying to say a lot of things, by the Africans to Chinese and by the Chinese to Africans. And the businesses around that should translate that into what we're talking about now. What I see with the Chinese business, though, is that the mandate and the instruction from the Chinese government is very clear with them. We are not confused about what they are supposed to implement: construction, infrastructure, commodities, all of that. And good for China because it's very clear in my head, I see it. For South Africa, though, the weakness we've got is that the relationship between big business and government is not as strong. And so the businesses are working in silos. The big guys, they think they can just go to China and do what they like. They don't need government until they're in trouble. Whereas with China, as the time they leave China to Africa, they are backed by their government. Then the second thing the Chinese government does is to leave some of the powers with the provinces. In China, the provinces are very powerful. When you deal with Hebei province, you are not worrying about what will the national say. So, and so the experience, and I think the third thing is that the businesses in China, of course, they have the benefit of being owned by government as well. But being owned by government means owned by the national, being owned by the province, being owned by the local authority. So when you're dealing with the South African, with the Chinese business person, you are dealing with all layers of Chinese government. In the business. In South Africa, no. And so the weakness, we have things that we can also be going to China and insisting on them being done. We are the wine producers, with 1.5 billion people who are now interested in drinking wine. I don't know why we don't have these liters of wine being all over the place.
Let's bring Glenn into the conversation at this point, because Glenn, a lot of the focus then needs to be placed on the structuring of these deals. Do we have the right deal-making capacity, in your view?
Yes and no. I think what Gloria's saying is 100% correct. In fact, there was a summit in Sharm just recently where it was a UNIDO summit, China-Africa summit, where a lot of the African leaders were saying that we don't want to just export cocoa beans to China. We actually want to export chocolate. And it was actually very well received by the Chinese government, who have now agreed that we need to actually beneficiate a lot of the product here. So I think that's going to help us a long way in putting these deals together, that we beneficiate the products in Africa and then export them whether to China or to other continents as well.
Of course, Greg, with the Chinese, investment policy so fine-tuned, what we have is we get, for example, Chinese involved in these infrastructure development projects. It spans across the continent. We've had a $23 billion investment in Nigeria, and that amongst China's, biggest investments on the continent. But what are some of the challenges that comes with managing a relationship like that with an African country? Because another big question out there is, what does this spell for a player like Nigeria in this context, for example, where it's got a long-standing relationship with the US and China with a very clear agenda?
I think the biggest challenge that China has in managing its relationship with Africa is the fact that it comes from a completely different political background and system compared to the majority of African countries. 20 years ago, I wouldn't have said that because we only had a handful of African democracies. Today, more than 40 countries regularly hold multi-party elections. They are competitive elections. They may not be perfect, but they're completely different to where we were 20 years ago. China, of course, is in a different space politically in terms of its own developments and its own trajectory in that regard. And I think for the most part, the Chinese seem to believe that working with government is a sufficient avenue to cut these deals. And one of the lessons it probably learnt out of the Congolese purchase of cobalt and copper concessions is that actually African people have themselves fought for democracy. This hasn't been something that has been just given out by African governments in a charitable way, and that they have to view the relationship with African countries through the populace as much as they view it through the governments. And that, of course, demands a bit of a mindset change on the part of the Chinese. And I think one of the things that's happened very interestingly with the Zambian election is that the Chinese themselves have come under a lot of pressure in Zambia because they are in the small trading market spaces. They are pushing out the Zambians from those areas. The Banda government was seen to have a preferential relationship with the Chinese. And this, of course, backfired very much against Mr. Banda at the polls, with Mr. Sata, who became president last month, essentially saying, I'm going to take a different point of view with the Chinese. He hasn't done so yet, but that was one of his election manifestos. So the relationship with Africa, I think, is going to have to, from a Chinese perspective, be viewed very much through African people, rather than as this we'll do a deal with government type of relationship. Can I just pick up on something that Glenn mentioned about beneficiation? You know, beneficiation is a sort of hoary old chestnut that's always hauled out to describe how Africa should develop. It's, of course, not the responsibility of investors to ensure beneficiation. It's the responsibility of the domestic governments to ensure that that is a condition.
Yeah.
But beneficiation, particularly of minerals, the best analogy I can think of is like a chicken. And a chicken is basically soya and water. It's a receptacle for holding soya and water. Beneficiated mineral products are essentially ore and electricity. And we can't talk about beneficiation until we get the latter aspect right. And we are one of the most energy deficient continents around. So we're kind of, learning to run before we can walk in terms of saying to investors, whether they're Chinese or anybody else, you've got to beneficiate products. And you've also got to supply the electricity to do that. And that points to the critical issue which Gloria mentioned, which is our development is going to depend on our own national development, not just visions like Kenya's Vision 2030, but plans, and the relationship between government and business in the rollout of those plans. We can't expect anybody, whether it's the Chinese, the Germans, the Europeans, whoever, to do that for us. We have to do that as Africans ourselves.
Katenji, let's take a look at some practical examples in Kenya in terms of how Kenya is managing that relationship with China, and where beneficiation is a large part of the agenda moving forward. Can Kenya actually facilitate processes moving forward, even if China wants to set up shop in the country, manufacture on the continent specifically? Can Kenya cater to its needs?
I think two things. One, obviously, we have to make a differentiation between different kinds of investments from China. If we are talking about major infrastructure, I think clearly the relationship has to be with government, because again, that would not even be unique to Kenya or even to developing countries. It's the case even in Western Europe, in Russia. We see the Russian government at the moment very heavily involved with China in terms of agreeing about major investments. Now, in terms of manufacturing enterprises, small-scale investments, again, I think what the Chinese would have to do is what every other international organization has to do, and that is approach Kenyan investors. And Kenyan investors are really the dominant force in terms of investment in Kenya outside in infrastructure. Therefore, the Chinese or anybody else has no chance if they are not dealing with Kenyan entrepreneurs. The government, of course, is active in terms of promoting those relationships, in the sense that we are aware that there has been a shift in terms of international capital flows, and there is also maybe an obviously evolving shift in terms of opportunities for even tourism development and so on, moving a bit to the east. And therefore, the Kenyan government is, of course, keen to ensure that Kenyan entrepreneurs see the opportunities in China and elsewhere in the East, and at the same time that Kenyan entrepreneurs seek the opportunities to enter into partnerships with the Chinese in terms of investing in the Kenyan market.
Let's hone in, Gloria, on your partnership with a Chinese company right now. I mean, Wiphold has been integrally involved with a Chinese group in building a cement manufacturing plant in South Africa. Take us through your experience and how you're managing that relationship, where you say beneficiation is very much on your agenda.
It's a 6-year relationship because it comes from 2006 when that China-Africa summit did happen. And the one thing which we learned from that is the investment in the relationship itself is very important. And even when you have problems and hiccups, that relationship must sustain at that. The second thing is that there is no investor that looks for different things from another investor. Mm-hmm. Even the Chinese investors in South Africa, they're looking for consistency. They're looking for laws that are predictable. They're looking for certainty and all these things that come with the institutions that must sustain administration to administration. Back to the Zambia issue. It shouldn't matter that you have elections. Every 5 years there will be elections. The institutions must carry and be immune to the changes of administration. It's no different from us here. But the last point I wanted to say is that on those things where we are strong as South Africa, we are downplaying them. We are the top-rated country insofar as the auditing standards, the protection of the minority rights, the investor protection, the intellectual property, all those things. And when you have an investment relationship, these things count for a hell of a lot of things. We are stronger in South Africa administration-wise. Our Chinese partners are not. So somewhere here, they are strong in producing cement and building cement plant. We are strong on institutional and financial market development side. That is what an investor relationship is looking for. So we're having a wonderful time, I must say, because there is no time where we feel that the Chinese are taking us on a funny path and so on. But lastly, we are very much aware of what the South African government as a state is looking for. They have a job creation problem. Mm-hmm. We cannot pretend there's no such a problem, however we debate it. And so, however we look at these investments and the opportunity to have a foreign direct investor into South Africa, we also have to be creative and innovative about it and make it work. And the last point I want to say is that, for example, they build the cement plant. That's not the skill we want to acquire, because we are never going to be cement plant builders. But we are going to be cement producers. So as they are building in the 18 months, we are going to send our employees to China to learn how to produce cement, so that by the time that 18 months end, they are ready, and also the work ethic, which we like, that this 24-hour working or 18 hours is nice. So we want them to go and learn these kinds of things and come here and work in this plant with no hang-ups about 8-hour day or 5-hour day and so on. That is where I'm just saying we are spending a lot of time learning about each other's ethos and taking the best we can take out of them. That is how an investor relationship should be.
Of course, we've been beating that productivity drum
Yes.
for the longest while. Let's leave the conversation there for now as we head into a short break. When we come back, we take the conversation further with Glenn, Gloria, Greg and Katenji as well. We're back straight after this, so don't go away.